The Fed minutes are out. Are your assets in danger? It's about their meeting on January 27th to 28th. Split on future action, a hawkish pause, or even return of rate hike risk. Stay calm. Listen in as our two experts debate what it really means for you today.
I'm not calling for a crash. I'm saying the rules changed. The Fed isn't cushioning valuations anymore. When 40 times CAPE needs falling rates to breathe, and rates stop falling, that's not drama. That's physics.
Fair point. But stricter refereeing isn't the same as ending the game. Maybe the Fed didn't pull the oxygen tank. Maybe they just turned the dial from emergency stimulus to normal adult supervision.
When rate hikes re-enter the conversation, even theoretically, the reaction function shifts. Markets don't wait for action. They price the possibility. That's how regime changes begin quietly, before headlines catch up.
True, markets price possibilities. But they also overprice them sometimes. We've seen regime change become policy patience more than once. Investors have declared the end of eras before, usually right before the next rally.
10-year yields near 4.3% may not sound dramatic, but at extreme valuations, small shifts in discount rates matter. High multiples are fragile. When gravity increases, even slightly, altitude suddenly feels uncomfortable.
Absolutely, duration sensitivity is real. But yields were higher in 2023, and equity survived. Maybe 4.3% isn't a cliff. Maybe it's just a speed limit sign the market prefers to ignore when earnings cooperate.
Earnings helped, yes. But prices have already digested years of future perfection. When expectations stretch that far, even good becomes disappointing. That's how narrative-driven markets lose their cushion.
I agree, expectations are elevated. But markets don't only reset through collapse. Sometimes they move sideways and let earnings catch up. Not every over-enthusiastic forecast ends in tragedy, sometimes it ends in boredom.
Margin debt above $1 trillion isn't comforting. Leverage doesn't explode every day, but when conditions tighten, it accelerates declines. Risk doesn't rise politely. It jumps.
Leverage is definitely gasoline. But we still need a spark. Credit spreads aren't flashing red, banks aren't wobbling, and funding markets aren't screaming. Right now, the fire department is mostly on standby.
But markets shift before stress becomes obvious. By the time spreads widen dramatically, portfolios are already bruised. Regime shifts don't send calendar invites.
That's fair. Still, true regime breaks usually leave footprints: liquidity stress, funding pressure, systemic cracks. I'm watching for those. Until then, I'm cautious, not apocalyptic. There's a difference.
What if the Fed's safety net is thinner this time? If policymakers hesitate to intervene during asset declines, valuations reprice structurally, not cyclically.
If that happens, I'll happily adjust. But so far, the Fed sounds cautious, not indifferent. There's a big gap between higher for longer and good luck out there.
Markets are also pricing potential leadership changes. A more hawkish chair could prioritize balance sheet reduction. That alters liquidity expectations today, not just tomorrow.
Possibly. But pricing unconfirmed leadership philosophies can become speculative theater. Markets sometimes trade the trailer instead of the movie. I try to wait for the opening scene.
This feels like a slow burn environment. Not a sudden crash, but prolonged compression. A drawn-out recalibration rather than a dramatic event.
That's actually where we converge. Compression is plausible. I just resist framing every compression as existential. Sometimes it's digestion, not disease.
AI isn't a fraud, but pricing assumed near-flawless execution for a decade. When capital costs stay high, flawless becomes expensive.
Totally agree. Buy at any price probably had its season. But buy selectively with discipline is different. Valuation sensitivity doesn't eliminate opportunity, it refines it.
My concern isn't drama, it's asymmetry. When leverage is high and policy support uncertain, Downside reactions can outpace upside surprises.
Asymmetry cuts both ways. Strong earnings in a skeptical market can force positioning shifts upward. Fragility doesn't automatically imply collapse. It implies humility.
So maybe we're debating terminology. Adjustment versus collapse. Regime shift versus late cycle tightening. But the era of blind enthusiasm feels over.
On that, we align. Discipline beats euphoria. I just think we're in a duration debate, not a systemic unwind. And until credit confirms otherwise, I'm staying analytical, not theatrical.
Markets are fragile under high rates, yes, but fragility is not destiny. Until credit markets confirm stress, this remains a valuation debate, not a financial extinction event.
Please subscribe our channel, leave your comments and let us know what you think. See you next time.